Welcome to the Coastal Business Channel. I am Laura. So today we're going to discuss asset allocation, portfolio management, type of what do you do basically once you have a client. So now you're a financial advisor, you've prospected, you've got a client, and I remember feeling this way. Client comes over with a check, came from the 401k. I've got this check, it's not invested in anything. I had other clients that came over with assets already, and that was kind of easier when someone comes with an asset versus a blank check. What am I going to do with this? And it was really funny because I remember sitting there thinking this when I had this account with a couple $1,000,000 cash, nothing else in there. And I'm thinking, okay, someone from Morgan Stanley's management is going to contact me because I'm a trainee and I'm 2 years into the program. I'm sorry, 2 months into the program, and I've got this money and I don't know what to do with it. And nobody contacts me. And they see money coming in. Now, I don't necessarily know. Well, I do know that they have access to your portfolio. So they knew that I had this cash sitting in the account. They knew that I've been employed for 6 months and been a financial advisor or full-fledged whatever, had all my licenses for 2 months, and I've got this money sitting there and nothing. So what do you do? Because like me, you might panic. Now, what I learned is that Morgan Stanley has these portfolios. You can plop that asset in. They take a little bit of the fee off, and you don't have to do anything. And they manage the portfolio, and it's based on, how long it's going to be and certain things and whatever. And I just remember sitting there like, well, that's easy. Except I've managed my own portfolio for 15 years. I've done extraordinarily well. And my husband has well with his portfolio. Like, that's an asset of mine. That's a skill I have that I think is an asset. So, hopefully you had that asset or you're willing to learn. And now what do I do with it? So I have had these conversations with clients, and you should as well, is to know what is their risk tolerance. I think when you open up an account, you need to know what is their risk tolerance. Are they looking for something that's for 5 years or 10 years? Is it liquidity needs? Is this wealth accumulation that they don't believe that they're ever going to have to draw on the account? All of that information plays into how I allocate assets in an account. So the easiest one is the person that says, I don't need this money for 20 or 30 years. In which case, I say, okay, well, are you comfortable with growth stocks? And I find out their risk tolerance. And, my growth stock is going to be a NVIDIA, maybe not right now, a Tesla, Apple, Microsoft, those types of stocks. It's not going to be a penny stock or an IPO or what have you. It's going to be pretty well-known companies. And I'm going to develop a portfolio that's all based on large cap growth stocks. I shouldn't say all, but that's going to be like the majority of what I'm going to build a portfolio around. The harder, person that I've had is I want my stocks to grow. I want, Starbucks like it was 20 years ago. I want you to find me the next Starbucks, but I need to draw, $3,000 each month. And I'm like, okay, well, that's becomes a significant amount of money in your portfolio that I now have to make sure you have the income for that, but then you want me to find the next Starbucks, which is crazy risky, which is it's a hard scenario, right? Someone that needs current income and does for the foreseeable future, but wants this crazy growth because they have almost nothing saved for retirement. That's ridiculously hard to do, and that needs to be explained to the client. And then you say, okay, well, we're going to kind of divide your portfolio. So the client that wants, everything, right? Wants a lot of current income, yet wants the next Starbucks, you kind of have to explain to them how the market works and how risk works, the efficiency frontier, all that kind of stuff. But so to me, that's where asset allocation comes into the portfolio management process. How am I going to manage this process to get them what they want? So Corey, first I say to them, well, finding the next Starbucks and drawing income are, they're not incompatible, but it's hard to do, right? I need to segregate, here's your portfolio. I need to segregate a good chunk to income so you can get your $3,000 a month without touching a principal. So I'm going to have that in equities. I'm going to have some high yielding dividends or dividend producing equities, Verizon. I'm not going to really get into specifics because this video can be watched at any time. So anything that I might say is a good stock now might not be a good stock when you watch this video a month from now, 10 years from now. But you're going to look at stocks that produce high dividends to get them their income. And then I want to have safe, right? They don't have any money saved for retirement, so we need growth, right? We need growth. Equities generally are the best security for inflation. You're going to be tested that on the Series 7, and that's the answer. What's the best asset class for inflation? Equities. Don't tell the market that last year. It wasn't, but that's because the Fed kept raising rates, and a raising rate environment isn't necessarily great for equities or large companies, but companies that use debt for financing. Anyway, so now you have to have that part of that portfolio base for growth. And you want to have a significant amount if they have nothing saved and then they have these lofty goals. And then you could tell them, okay, now we have this little tiny sliver where I'm going to find my Starbucks. So again, when you are a financial advisor, before you touch anyone's portfolio, any of their investments, you need to fully understand your client. That's why my initial meetings, my prospecting meetings generally go an hour, 2 hours. And part of it is I've had clients, before I even ask them a risk tolerance, I say to them, you're pretty conservative when it comes to investing, because I have listened to them and I have absorbed what are they saying in that meeting, right? Do they have a house and they have a mortgage to the tilt? Have they paid that mortgage off fully because they don't like having debt? There are things people say when you listen intently that you can kind of understand if they're a risk taker or they're not. People surprise you, okay? So you do have to ask the question, because what you think they're saying and what actually is how they feel about things are different. I have a son who is crazy. He loves roller coasters. Any type of roller coaster, I hate them. I won't go on them. He loves risk. He went ice skating and he didn't leave the side of the wall. And I just was like, wow, I thought he would have been all over the place. He's ice skated before, a lot of times actually. He knows how to do it. He doesn't know how to stop. But he was so nervous about falling. He's now like 6 feet tall, so maybe it's farther to fall than when he was little. But he surprised me, and that wouldn't have been my guess as how he was ice skating. So make sure you can't assume anything with your client. You always have to ask. But I do feel like they give a lot of information out that's going to help you kind of figure out how much of a risk taker. And I know at Morgan Stanley, when they had, when you're trying to find out someone's risk, they would say, like, how would you feel if your portfolio went down 20%? How would you feel if your portfolio went down 50%? And trying to find that risk. And you should be able to develop portfolios using the Sharpe ratio or Sortino's or Trainer's ratios to kind of figure out how much is there excessive risk in this portfolio? Is it aligned? Am I getting the return that I should off of the risk that I'm taking and the portfolio I'm developing, and that kind of scenario? But in general, the first and foremost, you need to sit down with your client and fully understand the time horizon, the goals of the portfolio, and what their risks are. And then you're going to develop that portfolio. So what I will tell you, for me, most of my clients have a growth portion of that portfolio. Now, it might be the whole portfolio, and it might be a tiny little sliver if they're looking for mainly income. It might be a really tiny sliver, right? I might have, a value play because they need the dividends, right? That might be a larger percentage. So I have main portfolios built. The one thing that is very different per client are bonds, because it depends when they're buying it, right? Because I hold individual bonds. They hold the bonds until maturity if they want a fixed income portion of the portfolio. But otherwise, most of the portfolios have about the same. It does differ over time. I'm not going to tell you they're 100% the same, because some clients come to me with huge capital gains in a taxable portfolio, and you don't necessarily want to sell huge taxable gains in a tax portfolio. So that's where things will differ. Anyway, I hope that was helpful with asset allocation. To me, it is really listening to your client and understanding what their goals are. And that really just dictates. It's not like I get to make it up however I want. Oh, all clients are going to be 60-40. No, it's really dictated by what the client's goals are, and then what they want. So thank you so much for watching. Have a nice day.